Welcome back to the Token Launch Masterclass. This is episode 5, SAFT versus SAFE versus Token Warrant, the legal instruments of a raise. Now, I know exactly what you're thinking. Legal agreements. It sounds about as exciting as reading a phone book. But let me be absolutely clear. Getting this piece wrong is one of the fastest ways I've seen a project implode. I once saw a team with a brilliant protocol get completely kneecapped because they used a standard startup SAFE when they needed a token-specific instrument. 12 months later, their cap table was a disaster and their investors were confused about whether they owned equity or tokens. This isn't just paperwork. This choice is the concrete foundation you pour. It dictates your valuation, your investor relationships, and your regulatory risk for years to come. Screw it up, and the whole thing comes down. So why do we even need these things? You might find it comes down to a classic chicken and egg problem, but with a crypto twist. You have a vision for a groundbreaking network, but to build it, you need capital. The catch is, the very asset you plan to sell, your token, doesn't exist yet. It's just a promise on a white paper. This is where these legal instruments become so critical. I like to think of them as the bridge. On one side of the chasm is your idea, on the other, a live network with a real token. These documents are the legal engineering that allows investors to fund the construction of that bridge, securing their claim to the tokens that will one day cross it. They are specifically designed to navigate the murky waters, where securities law meets digital assets, a tightrope walk from day one. So let's start with the instrument you've probably heard of, even outside of crypto, the SAFE. It stands for Simple Agreement for Future Equity, and it came right out of the Silicon Valley playbook, specifically from Y Combinator. In its natural habitat, it's beautifully simple. An investor gives you money now, and that money converts into equity, actual shares in your company, down the line at your next big funding round. What I like to see is a valuation cap or a discount included, as it rewards those early believers for taking a risk. Now, for crypto, we've had to adapt it. You might find that the most common approach is what we call a SAFE plus a token side letter. This means the investor gets the promise of future equity, but also a separate contractual right to future tokens, bolting the crypto component onto a familiar legal chassis. But if the SAFE feels like a traditional tool adapted for crypto, the token warrant is a much more direct approach. What I like about this instrument is its beautiful simplicity. Think of it as a classic option contract. It grants your investor the right, but not the obligation, to purchase a specific number of your tokens at a price you agree on today, which we call the strike price. That right isn't open-ended. It has a clear expiration date. Because it's structured as an option, its legal foundation is incredibly familiar and well understood. You might find that for investors who are purely focused on token exposure and aren't concerned with equity, this clarity is a huge advantage. It's clean, direct, and avoids any confusion about converting into company shares. Now let's journey to the instrument that was truly born from the crypto world, the SAFT, or Simple Agreement for Future Tokens. You might find it helpful to think of this as the industry's first real attempt to build its own bespoke legal tool from the ground up. The original intent here was quite clever, a kind of legal two-step. What I like about the initial theory is how it tried to separate two distinct moments in time. First, the fundraising. The SAFT itself was positioned as an investment contract, a security sold only to accredited investors to stay compliant. Then came the second step, the token delivery. A hope was that by the time the network was functional, the tokens would have genuine utility and therefore wouldn't be classified as securities upon their release. It was the original playbook for navigating a very tricky regulatory landscape. But that elegant theory, the neat separation between investment and utility, it ran headfirst into a regulatory brick wall. You might find that regulators, particularly the SEC, didn't buy the two-step. They looked at landmark cases like Telegram and Kick and essentially said, this is one continuous fundraising scheme. They challenged that core legal argument, and in doing so, they shattered the SAFT's reputation as a regulatory safe harbor. What I see now is that its initial promise has been significantly eroded. It's become a cautionary tale. Using a SAFT today is an advanced maneuver, one that you might find is highly dependent on your jurisdiction and requires battle-tested crypto legal counsel who understands every nuance of these enforcement actions. So let's put these two side by side, the SAFE and the SAFT, because you might find this is where the strategic choices really begin. What I like to do is break it down into 4 key areas. First, the underlying asset. With a SAFE, the ultimate prize is equity, shares in your company. A SAFT, however, promises one thing only: future tokens. Second, their regulatory philosophy couldn't be more different. A SAFE adapts existing, well-trodden securities law, while the SAFT tried to invent a new crypto-native path. Then there's the trigger. For a SAFE, the magic moment is a priced equity round. For a SAFT, it all hinges on the token generation event. You might find this naturally attracts different investors. What I see is traditional VCs often leaning towards the SAFE, comfortable with equity, while crypto-native funds are built for the direct token exposure a SAFT promises. Now let's put the two token-focused instruments head-to-head, the warrant and the SAFT. What I like to do is break down their legal nature. You might find it useful to think of a SAFT as a forward contract for delivery. You take the money now and you're obligated to deliver tokens later. The token warrant, however, is a classic option to purchase. It gives the investor the right, but not the obligation, to buy tokens in the future. What I see is a major difference in flexibility. SAFTs are strictly a pre-launch tool. A warrant, however, can be used at various stages, even after your token generation event. Because of this, you might find that the warrant is seen as a more traditional and less scrutinized legal concept, which can be very appealing. Okay, but what do the investors actually want? What I like to do is step into their shoes for a moment. You might find that a traditional VC, let's say one from Sand Hill Road, almost always prefers a SAFE. Why? It's all about downside protection. They're thinking, if the token project fails, but the underlying company pivots into a killer enterprise software business, their equity claim is still incredibly valuable. Now, a crypto-native fund sees the world differently. They aren't hedging with equity. Their entire thesis is built on token value. You might find they prefer the direct, clean exposure of a token warrant or a very carefully structured SAFT. For them, the risk analysis is simple. It's all about the token success, and that's the only risk they want to underwrite. So this brings us to the founder's playbook. What I like to do when I'm advising teams is walk through a simple decision framework. First, you have to ask, who are your target investors? You might find that a traditional VC fund will only touch a SAFE, while a crypto-native fund is looking for a token warrant. Next, what I see as critical is your jurisdiction and your token model. Are you in a crypto-friendly region? Is your token a pure utility? Or is its function still speculative? The answers heavily guide whether a SAFT is even a remote possibility. And what about your company itself? You might find that if you're a standard C Corp building a product that just happens to have a token, A safe with a token side letter makes perfect sense. But here's the absolute bottom line. What I stress to every founder is that you must use experienced crypto-native legal counsel, not your standard startup lawyer. It's the difference between a solid foundation and building on quicksand. So where is all this heading? You might find the market isn't staying still. It's getting smarter and more creative. What I'm seeing more and more are these clever hybrid instruments. The one I particularly like is a safe that also includes a token warrant. This gives investors the best of both worlds. They get the downside protection of an equity claim if the company pivots, but also the direct token upside they're looking for. But what I also stress is that the ground is constantly shifting. You might find that what's considered market standard today in a crypto-friendly place like Switzerland is totally different from what's being done in Singapore or Dubai. This jurisdictional arbitrage is constantly reshaping which instruments are in vogue, making this a living, breathing part of your launch strategy. So let's pull this all together. What I like to do is boil it down to a simple mental model you can take away. You might find it easiest to remember it like this. The safe is your bridge to future equity. The token warrant is your clean, direct option to buy future tokens. And the SAFT is that forward promise for the future delivery of tokens. Equity, option, delivery. What I hope you see now is that this choice goes far beyond the legal fine print. It's a strategic move that tells investors who you are and where you're going. Thank you for walking through this with me today. Now that you've secured the funds, the next crucial step is building the right team. So join me next time for episode 6, Beyond the Code, Building a Crypto-Native A-Team that VCs trust, where we'll cover exactly who you need to hire to turn that capital into a reality.